We've gone through a period, 1982 to 2022, that were the most benign economic climate in human history, particularly for Americans. Real and nominal interest rates were falling. The U.S. dollar was strong, so we could export inflation. The benefit of demographics, which is to say the baby boomers, the benefit of global trade liberalization, a wonderful time. All that's changed, but I don't think that investor perception has changed. I think that we've been schooled through 40 years of benign times to be probably more aggressive, more positive than we ought to be. In the near term, with regards to Bank of America, as an example, the regulators in their wisdom have allowed Bank of America to say that those obligations aren't being held for trading, they're being held to maturity. And if they will pay off, that they can value them on their balance sheet, not at market, but rather at par. And I believe that not one investor in 20 knows the difference between mark to market. It's a legislative sleight of hand that people don't care about. The last time I saw people care, personally, was 1973. And that was an interesting change of circumstance. I don't know if the change of circumstance will occur. I happen to believe that the U.S. government will be able, in the near term, to roll over its debt, because I believe that the American people have looked at quantitative easing, that's Fed speak for counterfeiting, is a good thing. That's how you manage an economy without any pain to individual voters. It reminds me of the Hemingway quote. I'll only paraphrase it because I don't remember it. How do you go broke? Gradually at first, then all of a sudden. It becomes a problem when it's perceived to be a problem. I can tell you this. I'm delighted to be starting up a new bank that has no long bond portfolio, when so many of our competitors that might otherwise have competitive advantages over us with established banking relationships have real, true balance sheet constraints. The problems that I discuss in my work, 141 trillion dollars in private net worth in the United States against $130 trillion in net government debt, is a problem over a decade. What Porter describes probably is a problem over a decade. I think what investors need to focus on, and speculators too, is the fact that the way out of the dilemma described by Porter and the way out of the dilemma described by Rule is to reduce the purchasing power of the U.S. dollar. You reduce the aggregate net present value of the debt while honoring the nominal value of the debt. In the decade of the 1970s, according to the Office of Management and Budget, the U.S. dollar lost 75% of its purchasing power. This isn't a number put up by some cranky old libertarian named Rick Rule or a young copywriter, great thinker named Porter Stansbury. This is the Congressional Budget Office. By doing that, we devalued the net present value of the obligations run up by the war in Vietnam and the war on poverty. We got through it. It was ugly. There was a reckoning to get through it. Interest rates quadrupled. It was not a pretty time, but we got through it. And we're going to get through this too. Investors need to be concerned because we're heading into this period of turbulence with on-balance sheet and off-balance sheet liabilities in a real, not a nominal sense, that were 4 times as high as they were, which is to say there's less string to push. But we're also heading into it with a society that's enormously richer and more competent. If you look at the gains in technology and efficiency that we've enjoyed since the period of the 1970s, this is still a time where a bunch of young kids can commandeer a garage in Sunnyvale, out pops Google or out pops Apple. That does 2 things. It makes a bunch of folks rich, but it also lowers the cost of doing business. It makes the solution to global problems less capital intensive. So we'll get through this, but it ain't going to be as easy as getting through the last 4 decades was. I think it's important to know that. I think it's important, too, that people understand one solution to this problem, 2 solutions perhaps. Despite the fact that your savings reduce your wealth, despite the fact that you're being paid 4.2% in a currency that's depreciating by 7.5 or 8, you have to keep liquidity anyway, because in a circumstance like 2008, if you have liquidity, you take advantage of the situation rather than being taken advantage of, by it. The other thing that you need to do is, if history is a guide, you need to have part of your wealth stored in gold. In the decade of the 1970s, when the purchasing power of the U.S. dollar fell by 75%, the gold price increased 30-fold. I'm not suggesting that the gold price increases 30-fold from here. It's already up 12-fold from the year 2000. What I'm suggesting to you is that the gold price likely increases in proportion to the deterioration of the purchasing power of the U.S. dollar over 10 years.
Let's start with an uncomfortable truth. From 1982 to 2022, we lived through what I would call the most benign economic climate in human history, particularly if you were American. You could practically fall out of bed and make money. Real interest rates were falling. Nominal interest rates were falling. The US dollar was strong, so we exported inflation. We had favorable demographics, meaning 76 million baby boomers entered their peak earning years and started spending, saving, investing. We had globalization, free trade, cheap labor, cheap energy, technology exploding from garages in California. In other words, it was easy, too easy. And here's the problem. We got used to it. We were conditioned through 40 years of tailwinds to believe that the system was inherently stable, that every dip was a buying opportunity, and that bad things, serious economic setbacks, couldn't really happen. That kind of conditioning sticks. It infects investor psychology, risk modeling, retirement planning, everything. We forgot what real volatility looks like. But that period, it's over. Full stop. And I don't think most investors have caught on yet. They're using playbooks built for a world that no longer exists. Now, I'm not a pessimist by nature. I've been an investor for over 4 decades, and I've learned that humans are remarkably resourceful, that markets can surprise you on the upside, and that there's a lot of innovation and capital discipline out there. But I'm also a realist, and right now, we are entering a period that is anything but benign. The debt is higher, the politics are more toxic, the interest rate regime has flipped, and for the first time in 40 years, inflation is a real, sticky threat. You can't paper over this with transitory anymore. One of the things I find most alarming today is that many of the risks we're facing are hidden, disguised by accounting tricks and regulatory sleight of hand. Take Bank of America, for instance. The regulators, in their infinite wisdom, have allowed them and other institutions to hold enormous quantities of long-duration bonds at face value, not market value, because they're held to maturity. Sounds innocent enough. But what it means is that these banks have massive unrealized losses that don't show up on the balance sheet. They're underwater, but not on paper. And the public? Completely unaware. I'll bet you not one investor in 20 could explain the difference between mark-to-market and hold-to-maturity accounting. And that matters because it distorts the real risk. It's legislative camouflage. We've seen this before. The last time I saw people truly care about this kind of risk was in 1973, during the savings and loan crisis. That was the moment when investors finally realized that numbers can lie when accountants help them. And I suspect something like that awakening is coming again. It reminds me of the old Hemingway line, "How did you go bankrupt? Gradually, then suddenly." That's how debt crises unfold. They simmer beneath the surface until they become too obvious to ignore. Suddenly, confidence disappears, and you realize the system was never stable. It was just well-perfumed. Now, I don't believe the US Treasury is going to default tomorrow. I do believe they can roll over their debt in the near term. But here's the catch. The only way out, the only politically viable solution, is to reduce the purchasing power of the US dollar. You don't default in nominal terms. You default in real terms. You pay everyone back, just in currency that's worth less. That's how you manage $130 trillion in liabilities against $141 trillion in private wealth. You inflate your way out. And Americans, bless their hearts, have decided that quantitative easing, which is really just monetary alchemy, is a good thing. Free money, no cost, no taxes, just a few digits on a Fed balance sheet and voila. Prosperity, at least until it isn't. There's a line I often use. Quantitative easing is just a fancy term for counterfeiting. You can dress it up, give it a PhD, but at the end of the day, it's printing money to cover fiscal deficits. And that never ends well. Let's look at the math. According to the Office of Management and Budget, not some gold bug newsletter, mind you, the US dollar lost 75% of its purchasing power during the 1970s. Why? Because we had to pay off the cost of the Vietnam War and the war on poverty. The only politically feasible way to do that was through inflation. The same logic applies today. We've piled up massive obligations, both on balance sheet and off. And the only way to reduce the net present value of those obligations is to inflate, to slowly, or maybe not so slowly, destroy the value of the dollar. And let's not forget what happened to gold during that period. It went up 30-fold. from $35 to over $800. Now, I'm not suggesting gold's going up 30-fold from here. That would take us to around $65,000 an ounce. But I am suggesting that gold will reflect, perhaps quite dramatically, the decline in purchasing power of the dollar over the coming decade. It already has. Since 2000, gold is up roughly 12-fold in nominal terms. That didn't happen because gold got better. It happened because fiat got worse.
I have a lot of liquidity. There is a lot of turmoil in the market. And while there's no guarantee of this, turmoil occasionally breeds real market panics. Turmoil occasionally breeds something like 2008. So mostly what I'm doing is I have a shopping list of opportunities that I'd like to avail myself of, companies in some cases, and I'm maintaining liquidity, looking to take advantage of that. I have a shopping list, frankly, of about 50 or 60 securities, as an example. And I have a nibble price, which is to say a share price that I would begin to establish a position in. And I have a gobble price, which is to say a price where I would really, really, really be an aggressive purchaser. On the other side of my portfolio, I have some speculative positions that I bought a year and a half or 2 years ago because they were really unloved. And I thought, well, I'm going to trade out of these things when they return to favor. So I'm doing that too. There are some companies that I think, in a speculative sense, are approaching their full value at this stage in the market, and I'm cycling out of those, looking for opportunities. So my portfolio is in flux. I would say that the dominant characteristic of my portfolio, relative to many other portfolios, is liquidity. I own, relative to the size of my portfolio, a lot of gold, and I have, relative to other portions of my portfolio, a lot of short-term cash. A lot of liquidity. But in addition to that, I believe that we're fairly early on in a gold bull market. I've lived through, this will be my fourth gold bull market, and they follow predictable patterns, Jesse. The metal moves first. When the metal has moved far enough, fast enough, that the gold price has outpaced the inflation in the inputs to produce gold, the margins in the biggest and the best gold companies move. You'll remember, Jesse, some frustration on the point of your listeners in 2003 when the gold price moved, but the gold miners didn't move. There were two explanations for that. One, the gold price moved because central banks were buying it. They don't buy gold stocks. The other was that the cost of producing gold was increasing as fast as the gold price. Beginning in 2024, the gold price accelerated faster than the inputs, and you started to see rapid margin expansions in some of the better gold producers. Two things happened there. They became worth more, but they got assigned a higher multiple too, as the narrative of the gold price extended to the gold miners. This occurs when you're usually about a quarter of the way through a gold bull market. So I suspect, if past is prologue, that we're a quarter of the way through this gold bull market. I believe, Jesse, that the cause of this gold bull market is primarily the deterioration in the purchasing power of the U.S. dollar, particularly relative to the interest being paid on U.S. dollar-denominated savings, which is to say negative real interest rates. And I believe that phenomenon will be with us for a fairly long time. Specifically, I believe in the next 10 years that the U.S. dollar will lose about 75% of its purchasing power. It will do relative to other currencies, but it won't do well in the absolute sense. I saw this happen myself in the decade of the 1970s. In the decade of the 1970s, the U.S. dollar lost 75% of its purchasing power. I mentioned this in this discussion because in the 1970s, the price of gold went up 30-fold. I'm not suggesting that the price of gold is going up 30-fold from here, and we could discuss why on another interview. But I do believe that the gold price will keep pace with the deterioration of the U.S. dollar, which is to say, I don't think that gold goes higher. I think it goes much higher. And I think that that will expand the earnings of high-quality gold companies, and I think it will expand the multiples that they're accorded too.
Let's pick up where we left off. You've got liquidity, you've got some gold. That's your foundation. But now the question becomes, how do you allocate the rest of your capital when the monetary system is essentially eating itself? Start with this. Don't expect the traditional 60-40 portfolio to save you. If 60% of your wealth is in equities, which are priced near historical highs, and 40% is in bonds yielding less than inflation, you're not diversified. You're dangerously exposed. That portfolio worked beautifully during the disinflationary era from 1982 to 2022, when interest rates kept falling, bonds rallied, and central banks backstopped markets. But that environment is gone, and most people haven't updated their frameworks. Let's talk bonds for a moment. U.S. Treasuries were the ultimate safe asset until they weren't. In 2022, long bonds posted their worst performance since the Revolutionary War. That's not hyperbole, that's fact. And we're not out of the woods. Real yields are still deeply negative, and the only way the Treasury can keep funding this massive debt load is by keeping nominal rates low and letting inflation run hot. That's financial repression by another name. So if you're buying long-dated bonds at 4.2% yield while real inflation is 7%, you're effectively agreeing to lose 30 to 40% of your purchasing power over the life of the instrument. That's not investing, that's self-sabotage. So where do you go instead? One answer is into real assets, tangibles, things that don't disappear in a spreadsheet. Gold, of course, but also silver, oil, natural gas, farmland, water rights, timber, infrastructure. These are the assets that not only hold their value in inflationary times, they often grow in real terms because they become scarcer, harder to produce, and more politically sensitive. Let me give you an example. During the 1970s, the best performing assets weren't tech stocks or bonds. They were energy equities, farmland, and precious metals. Why? Because the cost of everything else, transportation, manufacturing, food, was rising. Energy is the master resource. When you inflate a system, the inputs that go into every part of the economy also inflate. It's simple, it's predictable, and it's why I hold exposure to energy, particularly where capital expenditure has been underwhelming and demand is structurally rising. Another key theme, optionality. In inflationary or crisis-prone markets, optionality becomes incredibly valuable. Optionality means having exposure to upside without being wiped out by downside. This is why I like optionality plays in the mining sector. A company may have a large, low-grade deposit that's uneconomic at $1,800 gold, but at $2,800, suddenly it's in play. You can pick up these names for pennies, not because they're worthless, but because the market can't price in tail events. But, and this is critical, you need to do your homework. Optionality without due diligence is just a lottery ticket. I like to look for companies with legacy resources, no debt, and a history of capital discipline. They should also have a long enough runway. No need to raise cash every quarter to stay alive. Because when the sentiment turns, it turns quickly, and you don't want to be diluted into irrelevance right before the breakout. Let's talk psychology for a moment. Most speculators are wired for action. They want to be doing something all the time. But in these markets, the real money is made by those who can sit on their hands. I can wait 2, 3, 5 years for a thesis to play out. I have the patience, and more importantly, I've seen it happen. The 2001 to 2011 bull market in precious metals was a decade-long gift to those who were early and disciplined. The next one will be different in shape, but not in principle. I remember buying Uranium Participation Corp in 2004 when uranium was trading at $10 a pound. Everyone told me it was dead. No narrative, no volume, no catalysts, but the fundamentals were there. By 2007, uranium hit $135. Did I predict that exact number? But I knew that structurally the market couldn't function at those low prices. That same logic applies today to multiple commodities. The price isn't high because demand is weak. It's low because no one's paying attention. That's the opportunity. Everyone's still fixated on the next Fed meeting. Will Powell pause? Will rates go up 25 basis points? It's all noise. We are in a regime shift. The game has changed from monetary easing to monetary stress, from deflationary tech-driven globalization to inflationary supply-side bottlenecks and protectionism. You can't trade that with 5-minute charts. You need a decade-long lens. Now let me offer a view on the US government. There's a lot of chatter about default, collapse, revolution. I don't buy that. The US is still the richest, most innovative, most resilient economy in the world. We'll get through this, but we'll get through it the hard way. And the way out is through inflation, just like we did in the 1970s. But here's the rub. Back then, total US obligations were about a quarter of what they are today, adjusted for inflation. And the population had higher savings, more personal responsibility, and a better understanding of pain. Today, we've got enormous entitlement programs, soaring off-balance sheet liabilities, and a political class that won't touch anything painful unless they're pushed to the brink. That means the inflation we'll see in the coming years may be more aggressive, more persistent, and more stealthy than in the past. Stealth inflation, now that's something you don't hear often. It's the kind of inflation that doesn't show up in CPI, but eats away at your life. Shrinking package sizes, higher insurance premiums, fees layered into everything. That's the real experience of the average person. And it's why the smart money is already moving into assets that don't rely on government promises. Let me bring this back to gold again, because it's not just a hedge, it's a signal. When gold rises, it's not because the metal got shinier, it's because trust is eroding, and trust is the real foundation of fiat currency. Lose that, and everything else gets repriced. Gold has no yield, but neither does broken confidence. You can't fix a trust deficit with interest rate tweaks. Some people ask me, Rick, what about Bitcoin? And I say, well, what about it? I own a little as a speculation. I admire the idea of a stateless currency, but I don't confuse it with a monetary base. It's a protocol, not a substitute for 5,000 years of history. Maybe it plays a role in the future, but it hasn't yet earned the trust that gold commands in a crisis. If you want to be positioned for what's coming, here's my suggestion. Maintain liquidity, own gold, own some silver for torque, hold high-quality real asset equities, and for the brave, selectively own optionality in the junior space. Most importantly, be mentally prepared. This won't be a straight line. There will be corrections, panic attacks, fake headlines, central bank jawboning, and volatility. But if you've got a real plan and you stick to it, you'll be buying when others are selling and selling when others are still in denial. Let me end with a quote I keep close. It's from Richard Russell, the great newsletter writer. In a bear market, the winner is he who loses the least. Now think about what that implies in an inflationary bear market for bonds and fiat. Your job isn't to get rich overnight. It's to preserve and build wealth when everything else is leaking. It's to avoid being the sucker at the poker table. We're entering a hard cycle. But we've been here before. If you keep your liquidity, your conviction, and your humility, you'll come out on the other side not just intact, but better off. And if the world wants to print its way out of this mess, well, I'm happy to accept payment in ounces instead of dollars. Until next time, stay liquid, stay skeptical, and stay patient. The reckoning is coming, but so is the reward.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.